Kia ora koutou, I'm Garth Bray and this is Shared Lunch. Today we're with independent economist Tony Alexander. Another cut in the official cash rate. What does that mean for investors and homeowners alike? What's in store for 2025? Will things be as rosy or as grey as predicted? All of that, but first some important information you always need to consider.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Tony, great to see you. You're zooming in from the Gold Coast there. You look like you're surviving and getting ready to thrive in 2025. What did you make of the Reserve Bank's OCR decision?
Yeah, obviously not unexpected, 0.5%. That was what I was expecting, I guess, ever since the previous 0.5% cut. A number of people were saying, oh, things are so bad in New Zealand, they need to be cutting by 0.75%. But the story for the past 4 weeks or so has been people pulling back on those expectations in evidence of that maybe some of the underlying inflationary pressures are not necessarily falling away as rapidly for next year, at least, as people were thinking. For me, the most interesting thing, I guess, was that their release encapsulated sort of the two key themes I've been putting across for many months. Number one, interest rates will fall, but they're not going down to the really low levels that we've seen in the past. And number two, the economy will improve, but it's not going to be a particularly robust upturn. And that's what we saw with them cutting their economic growth forecast for the years to March 2026 and 27, about 0.6% for each of them, and yet lifting the inflation forecast 0.1 to 0.2%. That, I think, was quite significant from them.
So if this is a weather forecast, we've gone from mainly fine to scattered showers almost. It doesn't look quite as promising as we had first thought. And I mean, look, we've got a lot to talk about here today. We've had President Trump's election in the US and how that could affect things, and obviously where people see the housing market and go. But I really want to sort of dig in a little bit to some of the information that we got from Adrian Orr there. Look, I guess, would you be expecting then, if we look ahead to February, which is what a lot of people were trying to work out as well, are we looking at a 25 basis point cut, a 50 again, or something even stronger? Was there any indication that you took, particularly from what was said there?
Well, in the press conference afterwards, the pretty strong indication was given that they anticipate cutting 0.5%, and that's pretty much my expectation. It's going to take some fairly either unusually strong or unusually weak economic data between now and then, I think, to cause them to do something different from that. For me, my greater interest is not so much what happens in that third week of February, but what happens after that. I'm advising people to pull back on their optimism that rates might be falling to a great degree and that mortgage rates will fall away to a great degree. I really don't think that's going to be happening.
Yeah, I guess the OCR is pretty much back where it was 2 years ago, right? I mean, we had, that's when the RBNZ started to really aggressively increase the rates. And that was when that 75 basis point hike took off. I mean, so you don't see another 6 months of aggressive cuts? It's more like sort of 18 months of slowly getting there?
No, I think they'll get to about as low as they're going to go before the end of next year. Now, the Reserve Bank, they project the cash rate will finish 2025 at about 3.5% and then get down to 3% at the end of 2026. I think the easing cycle will be done and dusted well before the end of 2025, with the cash rate bottoming out somewhere between 3.5% if you're lucky. I think I recall one forecast I was reading just earlier on talking about maybe a 4% low. Well, we're at 4.25% at the moment, so I don't think that's going to happen. But yeah, I think it's going to be done and dusted by the end of next year, especially as the Reserve Bank anticipates extra strengthening in economic growth over 2026, which of course is going to make people start thinking about the cyclical upturn in inflation. And that's where my mind is focusing on at the moment, not the weakness in the economy at the moment, the falling away of inflationary pressures right now, but when does the cyclical recovery in inflation start? And that, I think, is going to be occupying people's minds in the second part of 2025.
Why is that so important to be thinking about now?
Because it limits the extent to which the medium to long term wholesale interest rates are likely to go down. We see elements of that now, and therefore the extent to which the medium to long term, well, even 2 years plus fixed mortgage rates go down. And so the time when people maybe more seriously start thinking about not fixing 6 months and fixing for 2 or 3 years, I think is going to come sooner than people are thinking.
If you're talking about that long-term picture, why is that so important to be thinking about it now?
Because at the moment, there's a high degree of optimism amongst, I think, the general population, investors, potential home buyers, that the interest rate cycle is going to be a really generous one, that the interest rates are going to fall away to a strong level, the economy is going to grow strongly, and the risk is people start making mistakes. Investors will bet on the interest rates going to low levels, so they risk overcommitting themselves to interest sensitive stocks, maybe commercial property, where of course the prices can be highly correlated with the other direction for the interest rate movements. For businesses also thinking, oh my goodness, we're going to see a great upturn in the economy because interest rates are going to go so low. I do not need to restructure at the moment. I do not need to lay off as many staff and find alternative supplies of materials because there's going to be all these extra customers coming through. It's going to be okay. Well, for many, many months, I've been trying to emphasize to business people in particular, the upturn will be mild. Don't think about just surviving to 25 and thinking you're going to thrive in 25. It's going to be a relatively mild recovery. Therefore, continue with your cost cutting. Continue with trying to find efficiencies and boost productivity.
Can you see why the psychology might be affecting people that for so long interest rates were so low that perhaps there's still a little bit of that hankering back to that period of predictability and an expectation that somehow we're going to return to that as the norm when there's a completely different normal now available?
Yep. And that's why in my weekly publication, I have a set of graphs at the on about the final page or the one before it, looking at where the fixed mortgage rates have gone over the past few years. I go back about 15 years, something like that. But I completely blank out the observations that the line stops and restarts again for the period 2019 when the world was worried about deflation. The cash rate was only 1% in New Zealand. I wipe that out. I wipe out 2020 and 2021 because they were pandemic years, very unusual circumstance. So what I'm trying to get people to do is realize, well, actually, the likes of the 3, 4, 5-year fixed rates are pretty much already below their average levels for the past 10 years or so, leading into 2019. And maybe that will start people thinking a bit more about not so much fixed 6 months, maybe I'll start fixing longer. Having said that, Kiwis just love to fix for the short-term interest rates. Hardly anyone ever goes beyond 3 years, and that'll stick around this cycle.
We're a long way from that American example where people lock in for 30 years or whatever, right? It's just part of the psychology.
Yep. And generally that's worked out okay. So if you look at the post-GFC environment, 2009 through to 2018 to 19, actually just rolling 1 year fixed gave the lowest cost of funds compared with going 2 year fixed, 3, 4, or 5 years over that period. But of course, you don't have much rate certainty. You're leaving yourself vulnerable to something coming along and kablooey. And of course, the world that we live in is one which is very uncertain. We're all trying to figure out, with the Trump presidency, what does that actually mean for inflation? There's a strong view on what it means in the US, but what does it mean in New Zealand? Scope for inflation and interest rate surprises is going to be really strong in the next 4 years.
I do want to try and get to some of that shortly, but let's just stay a little bit with that bigger picture here. If we've got a more subdued recovery through 2025, as you suggest, what is that going to do for some of the big pain points we've seen, like unemployment or the labour force participation rate and so on? We've seen some pretty high-profile examples of entire businesses or even industries that are looking like they're really under pressure after the energy crunch, mills shutting down in regional towns and just decimating that area. Is there more of that to come, do you think?
I think there's more to come across all sectors in the economy. For a long time, I was warning that 2024 would be a year of weeding out in the business sector across all sectors. So not just key pressure points like hospitality, retail, house construction, widely defined. But of course, as we can see, with the loss of a feeling of security about electricity availability and the price, that's feeding through to those long-term investment decisions in the electricity, in the manufacturing sector, highly dependent upon electricity. And this is one reason the upturn in New Zealand's economy is going to be muted. Businesses, whether you're already here in New Zealand or you're overseas thinking about investing in New Zealand, are going to have to think about the electricity availability. And you look at something like the data centres, which are opening up in New Zealand, estimated within about 5 years, they're going to be using 500 megawatt of energy. By then, that'll be about 25% of what's used by Auckland households. It says that the electricity availability is going to get even worse, especially if people keep plugging in more electric vehicles and maybe electric scooters and things. So that's quite a change in New Zealand's dynamic where, since all the hydroelectric schemes were developed into the late 1970s, there's been a feeling of electricity is readily available in New Zealand. That's a sea change in view this year. So there's probably a bit more of that, unfortunately, that's rolled through parts of the manufacturing sector.
Let's try and give people some hope. Do you see any green shoots in there? Are there any investment decisions that are likely to proceed in this uncertain environment?
Oh, look, we are undoubtedly looking at an improvement in the New Zealand economy. When I've been giving talks over the past 3 to 4 months, and I've been running through my long list of reasons why we're not going to thrive, I have to stop myself about every 7 minutes and say, now, just to remind you, we are going to see a recovery in the New Zealand economy, but it's going to be more like when we came out of the global financial crisis, where the peak rate of growth was about 4.1% in 2015. It took a long time for things really to get chugging along. It's not going to be for this cycle a repeat of coming out of the recession 97, 98, when we were growing 6% within 18 months, or coming out of the 1991 recession when we were also growing 6% within about 2.5 years. This is going to be a relatively mild upturn, and some of the factors contributing to it will be obviously the interest rate or the foot on the pedal being lifted off the brake by the Reserve Bank. So taking off interest rate restraint. Not putting on interest rate stimulus is, I think, what I'm saying to people. They're not going to put the foot on the accelerator by cutting the cash rate to 2.5%, but thank goodness they'll be taking the foot off the brake. There's a lot of infrastructure spending to be done in New Zealand over the next, century, quite frankly, so there's going to be a lot of firms actively involved in that. There are some early signs of stand-alone house construction starting to look better through 2025, not multi-unit construction, townhouses, etc. 2026 if you're lucky. But for the standalone houses, things are starting to look a little bit better there. There's been a good improvement in dairy prices recently, so that will feed through, especially into your Taranaki, Waikato, South Canterbury, Southland sort of regions, so that's positive. Across here in Australia at the moment, there's just people noting there's some reasonably good upward pressure on red meat prices for a variety of reasons, so maybe there's some hope for our red meat sector in New Zealand, where about 40% of them are still running at losses at the moment. So there are those positives. The tourism numbers slowly improving, and the net migration numbers, I don't think they're going to go into the negative territory some people were forecasting a few months ago. Maybe we bottom out with an annual flow around about 40,000 or so. So down from a year ago, 136,000, but still in the positive territory.
I want to pick up what you said about standalone construction there, and obviously that's an indication of some pretty firm intentions that people are prepared to take a bet on where interest rates are headed and so on. But I noticed in one of your recent investor briefings you were saying that investors are really shying away from new builds. What's going on there?
Yes, I think for the investors, they can see that there are many properties listed for sale. So the stock of listings for buyers generally is the best since 2015, up about 26% from a year ago. And the focus for buyers generally is on those existing properties, maybe where they can make some changes and improve their yield. So as an investor, you're not just looking at, this is what it costs, this is how much I'm going to borrow, this is the rent I'm going to get, and it's a simple equation. You just plug it in and away you go. as an investor, you might be looking at, okay, well, here's a property with subdivision potential somewhere down the track. Here's a property where I could think about adding or taking away a room, a garage, doing something. So frankly, it's more fun buying an existing property, as long as it's not a townhouse, than would be the case just buying something essentially off the rack. I can see from my various surveys, the real estate one in particular that I do, that the investors are now coming back into the market. They're obviously encouraged by the restoration of interest expense deductibility, bright line changes, and interest rates are going down. But yeah, they're very wary of what they see happening, especially in the multi-unit housing area, the townhouse area. There are obviously some big problems in one or two areas there. There's an oversupply for the moment. It's only temporary, of townhouses up in Auckland. And there's, I think, just a concern that they may look to make a purchase, but maybe are not going to get a tenant quite as quickly as they would hope. That will change down the track, and the investors will start looking more favourably at new construction and townhouses in particular, but just not at the moment.
But that's, I guess, going to keep a bit of a clamp on the supply, and that's going to dissuade some of those developers from developing at scale, right? Which is just going to keep that, keep people focused in that established property market.
For the developers, certainly of the multi-unit complexes, they can't get the pre-sales at the moment, and they're not going to get the finance from the financial institutions. And so that's why I think maybe for some of them, if they're still looking to be builders, they may be biasing back towards purchasing sections and building something rather than going down the townhouse route for the moment. New Zealand cities need to intensify. So this is definitely going to come back again. The difficulty here is that we have decades of data on standalone house construction. We've got the graphs going up and down. We can see what happens. The numbers usually bottom out around about 15,000 consents. We've done that. It's starting to slowly edge up. For the multi-units, for the townhouses, basically, we don't have any cycles at all. This is the first decent downturn. So we really don't know how low it's going to go down. And that's why, frankly, when we economists are talking about house construction, the levels of activity, we're sort of all over the place at the moment, because we've got a feeling for the standalone house construction, but for the multi-unit, don't know. History gives me zero guide on when that's going to start picking up again on the construction.
Oh, I won't hold you to it until we get the results in, I guess. In terms of those new home buyers, obviously the debt to income ratio changes that have come in and so on, is that starting to filter through from what you can see?
Yeah, for the DTIs, there, 20% is a reasonable exemption, quite frankly, for banks, to lend above 7 times income for the investors and six times for other people. So, there is still quite some good scope in there. But as the market heats up and prices rise more for the existing houses, we will see people start to look back at getting something built. But the numbers don't really work out there. It's relatively cheaper for most people to be looking at purchasing an already constructed property than getting something built. Now, when I look at the cost of building materials, there have been some decreases, but it's relatively mild. I don't think there's much of an extra decline in the cost of construction that's going to come along. And, when we've been talking for some time about 40% increases in the materials costs for building a residential property in New Zealand in the past 4 years, you find the same numbers if you're looking at material out of Australia or out of Ireland, for instance. And there is not an expectation that goes backwards and all of a sudden everybody's building lots of standalone houses. A lot of these extra costs are locked in. So for home builders, it's like they're going to have to actually wait until we get a decent increase in the prices of existing houses. And, for 2025, I think it's reasonable to think that house prices on average rise 5, 7, maybe slightly more percent, and then maybe a little bit more than that over 2026. So the time will come for the higher residential construction, but I think the pace of price increase is going to be relatively mild the next couple of years.
Now, you're coming to us from the Gold Coast, so I want you to quickly inflame people by telling us how the property market's been working over there, just by way of comparison.
Yes, well, you've got the baby boomer generation and the one below that cashing up out of the major cities, and they're selling $4-5 million houses in Mosman and other flash places across in Sydney, and they're prepared to lay it down on 150, 180 square metre apartment here on the GC. there's all these towers going up all over the place. They build them really quickly, 2 years from go to woe for a 27-story building just down the road. For instance, the demand is massive for property here. There was an estimate from a evaluation group yesterday noting that on the GC, they need to build, for expected population growth, 50 skyscraper apartment blocks each year over the next few years for the population growth. What it adds up to is demand is so strong and supply is crimped. Remember, cost of materials have gone through the roof. Prices on the GC have gone up on average 70 to 80% for apartments in the past 4 years. Demand versus supply. That's what happens.
Get out, really?
Yeah, it's quite extreme. It's totally different from the cities, the 8 capital cities around Australia, where actually there's falling prices at the moment in Sydney and Melbourne. Not sure about Brisbane, but the markets can be heavily influenced in the cities by what's happening with migration numbers, which have been relatively strong, but there's a bit of a movement still of some people to the regions. And that's a dynamic we don't get to the same extent in New Zealand. Like during the pandemic, yes, some Kiwis sold in the cities and move to the regions. But probably we're talking the older generation who were going to do it anyway. And they just brought forward those plans maybe by 3 years of selling in Auckland and going to Havelock North, Hastings, other places like that. It's a stronger phenomena in Australia of people moving out of the cities and into the regions. The numbers are greater.
Gosh, if you can swing a hammer, get to Coolangatta straight away. Look, I'm interested, we mentioned the uncertainty that's been created in the world by the US presidential election, people trying to work out what's going on there. I mean, I know it's MAGA is the acronym, but it's almost like VUCA, volatile, uncertain, complex, and I always forget, ambiguous is the last one. Is that a pretty fair depiction of how investors are looking at what that election means for the prospects of growth and where rates and where exchange rates and things are going to go and how that could affect our economy?
Yeah, I mean, the investors are scrambling around trying to figure out exactly what this means. Now, clearly, with the cryptocurrencies have rallied very strongly. I mean, they're just purely a speculative asset anyway, but the speculation is that President Trump has been saying some nice things about it, and Elon Musk is in there, and he's got his own Dogecoin, I think it is, if it still exists, and the department that he's heading there has got the same DOGE acronym there, first letters. So people are looking at that asset. There's a feeling that maybe inflation in the United States is going to be higher than would otherwise be the case because of the tariffs, which are going on materials, goods going into America. Already firms in Australia are holding pre-tariff increased sales. Buy now before the price goes up for goods coming in from Mexico, from Canada, China, etc. Of course, what we don't know is how much of all of these threats for tariff changes are really just bargaining positions to get something else in exchange, either better trade access or something of relevance in the geopolitical sphere, for instance. We cannot know. And so this is going to be an environment of high uncertainty for the next 2-4 years, etc. For New Zealand, the risks lie a bit on the downside here because we export minimally processed commodities to the rest of the world. A lot of the rest of the world has strong farm lobby groups who would like our stuff not to be going in there. And if we're looking at a world reverting more towards mercantilist policies of tariffs to somehow protect your domestic producers, manufacturers, farmers, etc., we do risk getting a bit lost in the wash there and having some negative outcomes. So the environment for ourselves has become riskier for the next 4 years, and that may just constrain some investment in New Zealand in this period of time. The interest rate implications, difficult to figure out, but I'd say interest rates, again, not going as low as people are thinking because of some enhancement of the inflation risk.
If we were trying to wrap it all up, what's your best advice for how to make the best out of 2025, Tony?
I think people anticipate some recovery in the economy. The labour market improving. You asked earlier on, Garth, about the unemployment rate. You know, we're 4.8% at the moment. Go to 5.5%. I guess I'm not greatly concerned about that. We had 6.7% back in about 2012. I think 11.1% or so back in about 1992. You know, we've seen far higher unemployment rates in the past. That will act as a constraint on the strength of recovery and consumer spending for a a lot of 2025. So I think there's more rationalisation to come in the retail hospitality sector. And because we're in sort of the last stages of the weakness for the economy, that doesn't mean things improve for businesses generally. As we see, the failures, liquidations are picking up because some firms do not have the cash flow for the final 3 to 6 months of the period of weakness. It might be the IRD demanding, tax payments, etc. We will see further weeding out across all sectors, but the scene is being set for better activity in our economy, mainly the second half of 2025 and 2026, rather than the first half of 2025. Conversely, for the biggest parts of the falls in interest rates, that'll be done and dusted, I think, quite frankly, by the middle of 2025.
Crikey. So it sounds like Merry Christmas 2025 than Merry Christmas 2024 from your point of view. Thanks very much, Tony. And thanks all of you for watching and for listening. If you're listening, you're probably on Spotify, Apple, or wherever you get your podcasts. If you're watching, you're on YouTube. And if you like what you see, let us know and let us know what you'd like to see next. For us, that's done. Ko mutu.